I'm Jordan Roy-Byrne, and thank you for coming today. And just a little bit on my background. I focus on technical analysis, but really from a macro perspective. That's probably half of my newsletter focuses on market timing, technical analysis. The other half is picking companies and doing fundamental analysis on those companies. So today I'm going to talk about the technical side and what I see. And gold's fundamentals right now are not bullish. I know that's probably shocking. I don't think anyone has ever said that at a metals conference. There's probably a reason why I'm speaking last. Is that right, Scott? I don't know where Scott is, but I remember when I was really bullish 2 years ago, I was the first speaker. Now I'm not bullish, or I'm the least bullish person, so it makes sense that I'm the last person here, have a smaller audience. But anyway, I'm just giving Scott a hard time. But so gold's fundamentals, they're not bullish yet. I think sometime next year they'll turn bullish, but they're not bullish yet. And I'm going to talk about why. But you guys hear a lot of presentations, so I want you to just get to, if there's a couple of things you should remember, it's number one, gold's fundamentals are not bullish yet. Number two, and this is the most important, a bull market will begin in precious metals when the Fed is done hiking rates. And I'm going to talk about that in the next couple slides. So that's probably the number one most important point to take away from this. You can all tune out in a couple seconds. That's just the only thing you really have to remember from this presentation. And then lastly, right now, until fundamentals turn bullish for precious metals, we need to focus on exploration discoveries, companies that have a good chance to make a discovery, or companies that have made a discovery and it looks like they could really grow and expand that, because that's where the money is flowing right now. And fortunately, some money is flowing. It's not all bleak. It's just, unfortunately, we don't have the backdrop of strong metals prices in precious metals right now. So you have to be a stock picker, and you have to focus on exploration and those stories. Either they're making a discovery or they're growing a discovery and adding value to that discovery in some way. So yes, gold's fundamentals are not bullish yet. So why? Well, 90% of what drives gold is real interest rates. Gold is inversely correlated to real interest rates. If you follow my work, you see me talk about this all the time. You're probably sick of it. I don't blame you. But just study history. 90% of what moves gold is real interest rates. When real interest rates go down, gold goes up. When real interest rates go up, gold goes down. So over the last, since the end of 2016, what happened? Well, real interest rates have been rising. You know, gold hasn't really gone up. It's been going sideways. And gold has held up well because of the weak dollar. So, I mean, that's why gold has been stable despite negative fundamentals. And the negative fundamentals, that's more apparent in silver and the mining stocks, which have trended lower while gold has trended sideways. And in this chart I have, you can see the real 5-year yield and the real 2-year yield, which is a proxy for the Fed funds rate. It's very simple. You look at the 2-year minus inflation or the 5-year yield minus inflation. And so short-term yields have more of an impact on gold than long-term yields. So long-term yields, I'll talk about those, but those breaking out and going up, that tends to be gold bullish. But short-term yields going up is not gold bullish, as we see here. So fundamentals for gold are not bullish yet. They were bullish in 2016. They turned bullish, but again, over the last 18 months or so, real interest rates have been rising, and that's why gold hasn't been able to break out yet. Again, gold has held up well because of the weak dollar, which is right now no longer weak. Now, let's look at Fed policy and gold stocks. And I was, a week or two ago, I was curious about, when the Fed starts cutting rates or they're done hiking rates, how do precious metals perform? So this chart goes back 60 years. I have the Barron's Gold Mining Index on there, and at the bottom I have gold. And we can see that most of the time, except for 72 and 76, and then I believe 93 or thereabouts, and then at the end of 2015, those are periods where the Fed started hiking rates, but gold stocks and gold went up. But most of the time when the Fed when they're done hiking rates, as you can see from this chart, it's those are the red lines are when they're done, or when rates start to rise again. You can see that's where those red lines are. The two main ones I'm talking about are 72 and 76, and also at the end of 2015. That's when the Fed was done cutting rates, or they started hiking rates, and the market went up. But where we are now, we've been unable to, gold has been unable to break out. Silver and the mining stocks have been trending lower, maybe you could say sideways in some cases. But that's with the Fed hiking rates. And the problem that we have is inflation has been rising, but as I showed you on the last slide, the short-term yields, like the 2-year and the 5-year, they've been screaming higher. They've been rising even faster than inflation has been rising. And so that's the problem for gold. And I see that continuing over the next 6 to 9 months or so. I think the Fed's going to be able to continue to hike. And I don't see inflation spiraling out of control yet. I don't see that happening until probably the next economic cycle. So because of that, I think the Fed's going to be able to continue to hike, and real interest rates are not going to decline, at least in the next 6 or 9 months. But anyway, I'm sorry for getting off track. Back to Fed cuts in the gold stocks. Considering this history, this tells me when the Fed is done hiking rates in this cycle, that will be the start of when gold and gold stocks and silver also, when they start to rise and continue to rise and sustain that, not just like a weak rally for a couple months like we've been having. So that's my biggest takeaway. And I see there's a lot of similarities between what's been going on now and the 1999 to 2001 cycle. It's very interesting because, as we know, in the mid-90s, we had a really nasty bear market in commodities and also in gold and gold stocks. And what happened is, with respect to gold and gold stocks, when the Fed started hiking rates again in 1999, we had a big rebound in gold stocks and gold, and also commodities, the CRB, that's commodities at the bottom. But what happened as the Fed continued to hike rates is the stock market continued to do well, commodities continued to make higher highs, but precious metals, gold and gold stocks, they fizzled out. So that's exactly what's been happening the last couple of years in the cycle that we're in. There's a lot of similarities. It doesn't mean we're going to repeat everything to a T, but what this history also tells me, well, I'm sorry, let me go back for a second. So what happened when the Fed paused and then they went to a cut? That's when gold and gold stocks bottomed and began a real bull market, and that's when the other, commodities struggled at that time for a little while. They bottomed later in 2001, and of course we had a bear market in the stock market. So it looks to me like 2016 to 2019 could reflect 99 to 2001. Okay, the U.S. dollar rebound. The dollar is rebounding right now, as we know, and I don't have that strong of an opinion on the dollar. Some people think it's going to continue to rise and go and retest 104, that recent high. One thing to watch is the 40-month moving average. You can see that not always, but most of the time it does a pretty good job of defining support and resistance, or the trend. And so I see a lot of resistance just below 96. So I think the dollar, I think it did hit 94 on Friday. I think it's going to continue up to the mid-95s. Maybe it'll touch 96. And we'll see what happens after that. I have, as a gold bug, I have a contrary view on the dollar right now. I want it to go up. I mean, look what's happened. The dollar had this huge move down the last couple of years, and gold couldn't break out. I mean, that is awful for our sector. When the dollar is really going down, gold and gold stocks should be flying, but that wasn't happening. And we're seeing problems in Europe, so the correlation between gold and the dollar might start to change a little bit. I'm going to talk about that in another slide. But for here and now, one thing to keep in mind with the dollar is the dollar continuing to rise, that can act as rate hikes for the Fed. So if the dollar, if we have this crisis develops because the dollar goes up too fast and all this dollar-denominated debt becomes a crisis with emerging markets, that would force the Fed to stop hiking. So there's many things that could lead the Fed to ending their rate hike cycle. The dollar going above 104, 105 and to a new multi-year high, that could be something that forces the Fed to stop their hikes. And gold against foreign currencies has held up, or I should say gold, and even in dollars, has held up really well despite the dollar rebounding. So I wouldn't, for gold, right now, the stock market is a bigger deal than the dollar because the stock market reflects the economy most of the time. And if the economy gets weak, the stock market rolls over, goes into a bear market, what's going to happen? The Fed's going to stop hiking rates. They're going to go to cutting rates. That's good for gold, and eventually that'll be bullish for the stock market. But it has, we have to go through a recession in a bear market first. So I know I kind of got off track, but I got there from the dollar. But anyway, let me get to the next. So yeah, talking about gold in real terms. Gold against gold, it looks like it's in a new bull relative to bonds. It's been rising, and that chart there is TLT, so that includes a dividend. So gold is beating total return bonds. Now, gold against foreign currencies, on Friday, I don't have this updated, but on Friday it closed at an 11-month high, and so that's gold against the inverse of the dollar, that basket. So gold against foreign currencies, we're looking at gold, but we're taking the US dollar out of it. So that closed at an 11-month high on Friday. If we're just looking at in terms of the weekly close, it's a new 52-week high. So that's a little surprising. I mean, it's definitely a good sign that the dollar's been going up, but gold has held up really well. Gold against the stock market. I mean, it's been clear to me over the last year or two, gold has been unable to break out. And a big reason why is we still have a bull market in equities. Money is still flowing into the equity market. And we're not going to have a bull market in precious metals until the bull market in the equity market ends. And that would be reflected by that ratio at the bottom, gold starting to rise against the stock market. I mean, every time it's risen and it's gotten above that moving average, I've gotten excited. Maybe this is the turn, but it's just rolled over again. And when that ratio turns up in favor of gold, that would also reflect or predict, because maybe that would lead, but that would predict the Fed or anticipate the Fed ending their hikes and then moving on to cuts because, there's problems with the economy and maybe problems in the stock market. Problems in the stock market would be reflected by that ratio rising in gold's favor. Now, here I have a chart of gold on the top and then the 30-year yield in the middle and the 10-year yield at the bottom, and I'm not quite sure that we're going to see long-term yields break out yet. We did see the 10-year broke out, but then it came back down, so maybe that's a false breakout there. The 30-year is probably, if there's only one you could watch, it's probably the 30-year. And the problem right now is if you're bullish and you're betting on much higher yields, too much money is betting against bonds. So in other words, too much money is betting on this huge breakout in long-term bond yields, which I think will happen, but my guess would be probably 2019, not this year. And if the dollar rally goes above that 96 level and it gets back to 100, and the bulls are right about that, that will affect oil, which is hugely inflationary. So that could bring down the price of oil. And the Fed, they could have like a 6 or 9 month window where inflation comes down a little bit and the Fed is still able to hike a couple times. That would be very negative for gold over the next 6 or 9 months. But it would lead to ultimately very bullish development. So the big key with bonds is I don't know if long-term yields are ready to break out here and now in this year. But they will eventually. And after they break out, that will be bullish for precious metals because a breakout in long-term bond yields, it'll start to affect the economy and then the stock market, and ultimately, as I've been saying, that's favorable for gold and precious metals. Now, of course, I have this cautious message, but in the big picture, gold stocks remain an incredible value. In this chart, we're looking at just the rolling performance over 5 years, 10 years, and 12 years. And on top there is the S&P TSX gold index going back to, I think, 1929. And we can see that in 2016, we hit, one of the biggest extremes as far as being oversold. And, we had a great rally then, and things have kind of fizzled since then. But looking at this and looking at also this is gold stocks against the stock market. There's just incredible long-term value. I mean, unfortunately, these charts, they don't necessarily mean anything for the next 6 months, 12 months, year, or 18 months. But eventually, as we're looking 2, 3, 5 years out, we are going to see very strong performance from gold stocks. I mean, the long-term value is there, but we need the fundamentals to come in place to drive more, the fundamentals for metals to come in place to drive more buying, drive more money in the sector. But the fundamentals for, we know with the industry needs deposits badly, and so those fundamentals are bullish, but the problem is the fundamentals for gold and silver prices are not immediately bullish right now. And here's another one. Look, we have the CAPE ratio, the cyclically adjusted PE ratio for the stock market, and when that peaks, or around the time that it peaks, gold stocks tend to perform really well. I mean, we saw it happen after 29, and then gold stocks started to perform really well in the early 60s, ahead of that peak. It happened again in 2000, and of course, valuations in the stock market are really almost insane. But valuations are not a timing tool, so we don't know, they don't tell you when things are going to peak. But we do know that valuations are at an extreme, and that when we get a bear market in a recession, usually during that period, we get really bullish policy for precious metals, and that's when precious metals really outperform. But again, we're not there yet. So finally, just 3 things to remember. Gold's fundamentals, not bullish yet. Secondly, when are we going to get a real bull in precious metals? It's going to start when the Fed finishes with their rate hikes. I'm very confident in that. As far as the timing, I really don't know. It's hard to say. Anyone's guess could be better than mine. I would say maybe sometime 9 to 15 months from now. So in the meantime, number 3, we have to focus, we have to remove metals prices from the equation and just look at companies, especially in precious metals, because I know the fundamentals for other metals are different, but especially for precious metals, we need to focus on exploration and discoveries. Has a company made a discovery? Can they grow it? Are they adding a lot of value to it? Or can a ground floor company, can they make a discovery? Money is flowing into those areas, and that will continue to happen even without the help of metals prices, precious metals prices, probably over the next 6 to 12 months. So, there's kind of a bifurcation. And lastly, I do have a special 6-month subscription for $97. You can go to thedailygold.com/premium MIF to take advantage of that. I'll leave it up for a week or so. And that's everything I have for you today. Thank you so much for listening to me. And we have a couple companies coming up. First, we have Brian.